lot of people will ask me as a trader, how do you do stop losses like a professional trader? It's the most important thing because none of us want to suffer losses. If you look after your losses, the profits take care of themselves. So let me explain it to you. Okay, one of the most important principles of all successful hedge funds in the world, I've never seen a hedge fund which is successful which doesn't deploy this rule, is they have something called volatility-based stop losses. What does that mean? Well, that's their entry point there. Okay, and we'll worry about how we knew when to enter in another video, but assume that's where we entered. They make sure their stop loss is such that they doesn't get hit by market noise. So how do you determine market noise? Well, that's dependent on the volatility of the instrument. What does that mean? Well, that means see all of these movements in each period, whether it's the 1 minute bar you're looking at or the 5 minute or whatever. This up and down is how much or how volatile the market is in any given period. So you might look back over, say, the past 14 periods and work out that on average it tends to move up and down 20 points. So you might say, well, I want to make sure I don't get hit by market noise, because that doesn't tell me that I should exit. That just tells me it was market noise. So I'll put this at 40 points away. Now, maybe on another day, on another instrument, the volatility isn't 20, the volatility is 40. Well, on that basis, this stop loss would not be at this distance of 40, it'd be at the distance of 80. Double that. Now, I'm not saying double's the right answer. Some people say, oh, is it the Holy Grail? Is it 2? Is it 2.6457 points away? No, there isn't a Holy Grail. It's the principle that's important. You might put it 2 or 3 times away. Either way, it's the principle that is important. And what I have to say about this principle is this. Okay, that's called a volatility-based stop loss. The ingenuity of it is that you ensure that every stop loss is bespoke to the market conditions. Okay, now, what if the stop loss, because the market was more volatile, is twice as far away? Surely you're going to have just a bigger loss. No, because we're going to have volatility-based position sizing. In other words, if the stop loss is twice as far away, we halve our position size, so we're not losing more money, we're not taking more risk. Those are critical elements and principles behind setting stop losses. When you get used to it, you do it like this. Okay? Let me tell you something else which is critical to trading success. This isn't it. This isn't it. Having lots of screens, and that's me sitting at my desk in the office with lots and lots of screens, that's not the secret to trading success. Stop losses based on volatility and volatility-based position sizing are the secrets to trading success. So do not be fooled by people who go, oh, I've got lots of screens, therefore you must be good. It comes down to the numbers I've just shown you. If you do the sums right, then you're managing risk. This is what I've written in the past in the Financial Times as far back as 2004. So I'm bloody experienced at this. Okay, take my word for it. And if you do volatility-based stop losses the way I've said, then your performance will end up looking a bit like this, which is how the performance of all successful traders in the world looks. Out of 100 trades, yes, you will have about 40 to 45, which will be small losses. Why will there be small losses? Well, we don't have a crystal ball. And whilst we think every trade's just going to go up and up and up, sometimes they don't. Other things happen in the market. A president does a tweet, God knows what else happens, and all of a sudden the market turns. Well, you'll have small losses. You won't have big ones because you did a volatility-based stop losses. And of course, for the same reasons, you'll have some small wins. I wish they were all big wins, but they're not. Okay? And you'll have some big wins. Now notice, the small losses are pretty much wiped out by the small wins. So where are we getting rich as fund managers? Where are we really making our money? Whether it's me, George Soros, or anybody else. It is from the few, 15% big wins. Okay? The big trends that we got on the back of. And by making sure we never have a big loss. We never have a big loss. For private investors, their performance, if you profiled it, looks exactly like this. Except they have big losses. And that's the difference between a professional and a private investor. Private investor has big losses. That's what wipes them out. Okay? And often, because they cap their profits and they take their profits quickly, they don't even have big wins. Right? The other mistake private investors make when it comes to things like stop losses is they put them so far away that they have a whole bunch of small winning trades because they're so scared because their losses and losing trades are so big that they take those profits really quickly, but they never close or talk about their losing positions, and those get bigger and bigger and bigger, and they lose more and more and more money. Okay, so that's how we avoid this iceberg problem, by having those stop losses and keeping our discipline. So there you have it, how to do stop losses like a professional trader. Much more detail in other videos that I do. Follow me on YouTube, follow me on Twitter, and look out for my webinars. You'll see those, and again, I go into far more detail, specific numbers on all of those as well.